There is one deadline in Canadian retirement that you only get to miss once. It comes in the year you turn 71. There's no reminder letter from the Canada Revenue Agency, no grace period, no second chance. And if you miss it, the consequence is brutal. Your entire registered retirement savings plan, every dollar you spend a lifetime saving, can be treated as income in a single year. Not part of it, all of it. Someone with $500,000 saved could watch close to half of it disappear in taxes in one shot because of a piece of paperwork. That's not a scare story. It's the actual rule, and it's confirmed by every major bank and tax expert in the country. So today I'm going to show you exactly what the deadline is, what happens if you miss it, and because this channel is about keeping your money, not scaring you, the handful of smart moves that can save you thousands, even if you're nowhere near 71 yet. Here's the rule, plain and simple. Your RRSP has an expiry date. You are allowed to keep saving into it right up until December 31st of the year you turn 71. But by that same date, December 31st of the year you turn 71, the RRSP must be closed, not the year after. Not on your 72nd birthday, the end of the calendar year you turn 71, even if your birthday is in January and you have been 71 for 11 months. When you close it, you have three choices. You can convert it into something called a RRIF, a Registered Retirement Income Fund, which is what most people do, and I will explain it in a moment. You can use the money to buy an annuity, which is a guaranteed monthly income from an insurance company. Or you can take the whole thing out as cash, which almost nobody should do, because every dollar of it gets taxed as income that year. And that third option, the terrible one, is exactly what happens automatically if you do nothing. Miss the deadline, and the CRA treats your entire RRSP as deregistered. The full value gets added to your income for that year, all at once. Think about what that means. Say you have got $400,000 in your RRSP. Suddenly, your income for the year is not your pension plus a bit of interest. It is $400,000 plus. That launches you into the highest tax bracket in the country, where roughly half of every dollar goes to tax. Decades of careful saving, and a chunk the size of a house price gone, not because you spent it, not because the market crashed, but because a form did not get filed by New Year's Eve. Now, let me be fair and honest about one thing, because I promised you facts, not fear. In practice, your bank or investment company will usually contact you as you approach 71, and many will convert your RRSP to a RRIF automatically rather than let it collapse. That safety net catches most people. But, and this matters, the legal responsibility is yours, not theirs. People with self-directed accounts, people who have moved and missed the letters, people with an old, forgotten RRSP at an institution they have not talked to in 20 years. Those are the ones who fall through. The rule does not care that you did not get the letter. So the fix is simple and free. If you are anywhere near 71 or your parents are, make the call and confirm the plan before December of that year. Advisors recommend doing it by November at the latest, so paperwork delays cannot sink you. So that is the trap. Now let's talk about what is on the other side of it. Because converting to a RRIF is not the end of the story. It is the start of a whole new set of rules that catch people off guard. A RRIF is basically your RRSP running in reverse. Your investments stay invested, the money keeps growing tax sheltered, but instead of putting money in, the government now forces you to take money out. Every year there's a minimum you must withdraw whether you need it or not. In the first year after converting, that minimum is 5.28% of your account. On a $250,000 RRIF, that is about $13,500 you are required to pull out and pay tax on. And here's the part people do not see coming. The percentage climbs every year as you age. By age 80, it is 6.82%. By age 90, it is nearly 12%. The government sheltered your money for 40 years, and now it wants its tax back on a schedule, whether the timing suits you or not. And those forced withdrawals are exactly how one trap leads into another. Every dollar that comes out of your RRIF counts as income. If those forced withdrawals push your total income over $95,323, that's the 2026 line, the OAS clawback kicks in and starts taking back your old age security, 15 cents for every dollar over. So a big RRSP, which sounds like pure good news, can quietly become a machine that generates income you didn't ask for, at rates you don't control, that eats into government benefits you were counting on. Good savers get punished by this more than anyone. So what do you actually do about it? Here are the moves that matter in plain terms. First, and this is the big one, you do not have to wait until 71. You can convert some or all of your registered retirement savings plan to a registered retirement income fund earlier, or simply withdraw from your registered retirement savings plan gradually in your 60s, in years when your income is low. Some people retire at 62 or 63 with a few low income years before their Canada pension plan and old age security start. Those years are gold. Pulling money out then at a low tax rate shrinks the registered retirement savings plan so that when 71 arrives, the forced withdrawals are smaller and less likely to trigger the clawback. Paying a little tax early on your terms often beats paying a lot of tax later on the government's terms. Second, if you have a younger spouse, there's a quiet option most people never hear about. When you set up your RRIF, you can base the minimum withdrawals on your spouse's age instead of yours. Younger age, lower percentage, less forced income every year. One box on a form, but you have to choose it when you convert. You can't go back and change it later. If nobody tells you it exists, you miss it forever. Third, once you're 65, RRIF income can be split with your spouse for tax purposes. Up to half of it can go on their return. If they're in a lower tax bracket, that alone can save a couple thousands of dollars a year. It's one form at tax time. Fourth, remember the first year is a freebie. In the calendar year you convert, you do not have to withdraw anything. Your first forced withdrawal comes the following year, and you can wait until December of that year to take it, keeping the money growing sheltered as long as possible. Small move, real money over time. And fifth, know what does not get you in trouble: your tax-free savings account. Money coming out of a tax-free savings account does not count as income, not for taxes, not for the clawback. If your forced registered retirement income fund withdrawals are more than you need to live on, one smart play is to take the minimum, pay the tax, and move what is left over into your tax-free savings account, if you have room. The money keeps growing, and from then on, it is invisible to the Canada Revenue Agency's income test. Let me pull it all together. December 31st of the year you turn 71. That is the deadline, and it is absolute. Do nothing and your entire RRSP can be taxed as 1 year's income at the highest rates in the country. Convert it to an RRIF and you are safe from the bomb, but on the hook for forced withdrawals that grow every year and can trigger the OAS clawback. The people who come out ahead are not the ones with the biggest RRSP accounts. They are the ones who plan the drawdown, who use low-income years in their 60s, who check the spouse's age box, who split income at tax time, who move the overflow into a TFSA. None of that is complicated. All of it just has to happen before the deadline, not after. If you're within 10 years of 71 or your parents are, take one action this week. Confirm where every RRSP is and what the plan is for it. One phone call, that's the whole defense. I've broken down the OAS clawback in its own video, how it works and how to stay under the line, and the real math on when to take your CPP. Same plain English approach, real numbers, no panic. I'll see you in the next one.